Hello everyone and welcome to episode 50 of JustDario Cigar Time. Today I want to redirect your attention to an incredibly important matter that people, completely absorbed in the euphoria of never-ending price increases in the stock markets, are totally overlooking. As of now, we are literally 5 days away from a potential banking crisis in the United States. Before we begin, don't forget to like this video, subscribe to my channel, and turn on the notifications if you like my work, want to support it, and don't miss my future updates. Exactly 1 month ago in my article, "No one will care about a US shutdown unless it sparks a bank run," I described in detail the various items and elements at play and how they would evolve the longer the US shutdown progressed. Fast forward 1 month, and everything has developed exactly as expected. Banks have started borrowing almost on a daily basis and in larger and larger amounts from the Fed's standing repo facility. The overnight reverse repo facility at the Fed has been drained virtually to zero, and bank reserves are literally crashing. They have fallen to the lowest level in the past 5 years, well below where these reserves stood right before the US regional banking crisis began. Crisis that, let's not forget, also took down the likes of Silicon Valley Bank, Signature Bank, First Republic Bank, and Credit Suisse on the other side of the Atlantic Ocean. I still consider it too restrictive to call it merely a regional banks crisis. But that's the narrative the media successfully convinced people to accept. In reality, larger banks were already in trouble at that time. That's precisely why the Fed intervened by opening the massive bank term funding program. We are now at a critical juncture, and the next 5 days will determine whether this simmering stress erupts into a full-blown crisis. The clock is ticking. According to the latest update provided by the Bipartisan Policy Center as of last Friday, at least 670,000 federal employees are currently furloughed, while roughly 730,000 continue to work without pay. Additionally, 1.3 million active duty personnel and over 750,000 National Guard and Reserve personnel are required to serve, potentially without pay. For many, the first pay date with zero compensation occurred last Friday. The Bipartisan Policy Center estimates that if the shutdown continues through December the 1st, roughly 4.5 million paychecks will be withheld from federal civilian employees, representing approximately $21 billion in missing wages. But the US shutdown impacts far more than just paychecks. It affects a vast range of government support programs for the population and businesses. The most glaring example of how a prolonged shutdown is impacting a larger and larger share of the US population is the expected end, tomorrow, of the SNAP program. For those unfamiliar, SNAP is the Supplemental Nutrition Assistance Program, also known as food stamps. People are now shocked to discover that 42 million Americans rely on this program for food assistance. Many keep claiming that the impacts of the US shutdown are still limited and that once it's over, everything will quickly return to normal. But we need to be careful here. This is true only up to a certain point. What people keep missing is that US government programs and subsidies of any kind create economic activity, both directly and indirectly, acting in a sense as economic leverage. In a nutshell, $1 of missing government payment has an impact of 2, 3, even 4 missing dollars in one corner or another of the US economy. The best proxy for understanding how much money has stopped entering and circulating in the US economy since the shutdown began is the level of the United States Treasury General Account. Since October 2nd, 2025, the TGA has risen by approximately $150 billion. It's crucial to keep a close eye on this indicator. Why? When money is paid out by the government from this account, it injects a lot of liquidity into the system, akin to quantitative easing, just to keep things simple. As you can see in the chart, every single time in recent years that the TGA was aggressively drained by the US government, it served as an incredible boost to the stock market bubble because it flooded the system with a ton of liquidity. Conversely, when the TGA starts increasing, it drains liquidity from the overall system. Very intuitive, especially from the banking system, creating a massive drain on bank reserves. This is an additional impact that comes on top of the other intrinsic problems the US banking system and the global financial system are currently facing in terms of liquidity. The reason is simple. Most assets in the global financial system are increasingly illiquid. Through the years, especially during the zero interest rate policy era, banks invested aggressively into long-duration fixed income assets, real estate, commercial real estate, and anything that could yield better than zero-yielding government bonds. Eventually, they even poured money aggressively into the high-yield space because, after all, the prime investments were exhausted and central banks kept pouring liquidity into the system. So banks really had no choice, so to speak. Fast forward to today, the problem is that most of these assets cannot be sold without avoiding steep losses. I see people still not understanding this. They look at the stock market going up and think everything is fine. But rising interest rates have created incredible mark-to-market losses that are being eaten by banks and private lenders throughout the globe. Regulators are turning a blind eye to this because, to paraphrase them, until we pour money in the market, there will be money to repay the principal. So ultimately, lenders will collect their whole principal, avoiding losses. Yes, they will receive less interest at the end of the day than you would have if they had invested later at higher yields. But it's going to be fine. That's not true at all. Why? Because those companies they lend money to, real estate firms, commercial real estate players, zombie companies and the like, can only repay all debt if new money is being lent to them. They are massively underwater if they try to raise new debt to repay maturing debt. But who is going to lend money willingly to these entities when the real economy has been heading downward for a long time, with an incredible detachment from the stock market? Even if central banks keep printing money non-stop, this money is not flowing freely around the plumbing of the global financial system anymore. Some parts of it are starting to clog because financial institutions are becoming increasingly wary about the potential credit risk of specific entities and their counterparties. This is another reason why, in the past days, we have seen a sharp increase in borrowing from the Fed standing repo facility, a facility created with the specific purpose of buffering any sudden stress in liquidity and funding in the banking system, starting from the US, to avoid a repeat of the repo crisis of 2019. The fact that this facility is being used right now, with all the liquidity still sloshing around, means that at least one institution within the group of banks authorized to borrow from it cannot borrow from the open market anymore, even when posting collateral. My bet? Norinchukin Bank. All in all, you continue to have an incredible amount of liquidity printed out of thin air by the whole central banking system, but is being channeled into fewer and fewer assets. After the recent wave of credit defaults, starting from the auto loan space, people are now paying attention to the carry trades. What's hilarious is that most of the cash is currently flowing into the riskiest part of the food chain, equities, inflating a bubble that is already at completely unbelievable levels. When you have the Fed chairman joining the chorus saying this is not the dot-com bubble, that the AI business is different, and it might not be a bubble at all, they are denying the plain numbers in front of them. This week, Nvidia became a $5 trillion market cap company. As of its latest report, it had roughly $11 billion in cash and $45 billion in money market instruments and other liquid instruments. An amount I expect to be significantly lower in the next quarter because the company committed to massive cash investments this current quarter. Yet, this very same company is running a $70 billion buyback program. They are valued at $5 trillion. Why do they need to splurge cash on buybacks at this valuation? I'll tell you why. People tend to forget that the price of a company's shares is determined by the last transaction, regardless of whether it was for $1, $1 million, or $1 billion. Aren't these numbers about NVIDIA overall rookie numbers compared to a $5 trillion valuation, objectively speaking? Yes, they are. Yet, people still apply unbelievable multiples and future expectations to a company that already has a ton to deliver in the future to maintain the current valuation levels. Another critical point people do not understand is that the engine allowing the bubble to keep expanding is the heavy use of 0-day to expiry option, which now make up most of the volume traded in the market, driving cash stock prices because of delta hedging. Because these options expire every single day, banks and brokers are taking on a huge amount of risk, while their balance sheet serviceability decreases. Isn't it intuitive how this increasingly fragile system can break all of a sudden? This entire system is based on leverage, rehypothecation, and high-velocity movement of capital assets throughout the books of banks to minimize capital usage while maximizing effective leverage. Rehypothecation is not being captured correctly by the current accounting system. 2 weeks ago in Why a Jefferies Bailout is Only a Matter of Time, I provided a glaring example of how a very fragile financial institution looks in the current environment. Institutions are making more and more use of any sort of short-term funding to keep enough liquidity on the books. But by definition, short-term funding can drain and evaporate in the blink of an eye. Everyone knows that banks can remain insolvent for a very long time. Think about Credit Suisse. But liquidity is what really matters for them to stay in operation. When people start to get scared about a bank or a broker, they won't keep their money there too long. They want it out, and ultimately, the bank will be forced to sell assets. When you don't have much in liquid assets to sell, even if you're solvent, the path to bankruptcy is not long. Jefferies is perhaps the weakest of the pack right now, if we exclude micro US regional banks or similar lenders that, unlike Jefferies, do have access to deposits. But this situation is present in many other global systemically important banks. Some, like Wells Fargo or Bank of America, notoriously use a lot of repo financing to keep operations running with minimal capital impact. To conclude, keep an eye on the US TGA account. Bear in mind that for every dollar withdrawn from the US economy and stuck in the TGA, the impact on the global financial system is greater than that of a single dollar. Remember that bank reserves are already very tight. They are very low in a more amorphous, fragile environment. If people end up smelling fire around a specific bank and the implosion is not quickly contained, the domino effect to larger and larger banks can be very swift. When the whole banking system is one of the fundamental engines keeping this entire bubble inflated, the ultimate way to visualize the situation is this. Imagine stocks flying high like an airplane, but one of the engines, currently the banking system, is already on fire. The pilot going to successfully shut down the engine and keep the airplane climbing? Maybe for a little bit, but without banks, the other engines like central bank money printing and government debt monetization will quickly stop working. You will have fewer banks to channel that liquidity through the system, which can quickly become clogged because they lack sufficient capital. The ultimate result, this whole bubble can burst all of a sudden. Banks and brokers supporting it in the background will be forced to step away because of lack of capital, liquidity, and collateral, resulting in a significant and sudden decrease in leverage that can create an incredible crash, driven by forced liquidation and margin calls. Thanks a lot for listening to my podcast again today, for supporting me on X and Instagram, and for reading my research at JustDario.com. I wish everyone a nice weekend.